Strong baht waits weak economy for Thailand. When people hear the phrase strong currency, it often brings to mind stability, prosperity, and global financial respect. After all, if your currency can buy more on the international market, it must mean your economy is doing well. But for Thailand, the story isn't so simple. A stronger baht does not always signal a stronger economy. In fact, in certain contexts, it can expose vulnerabilities and put pressure on the very industries that fuel Thailand's growth. To understand why, we need to explore what a strong baht means, the benefits it brings, the drawbacks it imposes, and how Thailand compares with other countries in managing the strength of its currency. What does a strong baht mean? A strong baht means the Thai currency has appreciated against others like the US dollar, euro, or yuan. For example, if $1 used to buy 35 baht but now only buys 30, the baht has strengthened. This appreciation can happen due to several factors: high foreign investment inflows into Thai stocks, bonds, or real estate, trade surpluses, exports exceeding imports, rising interest rates in Thailand, which attract global investors searching for higher returns, global risk aversion, where investors see Thailand as a relatively safe place to park capital, central bank interventions that indirectly affect demand for the baht. So, while a strong baht can reflect confidence, it can also distort Thailand's export-driven and tourism-dependent economy. Benefits of a strong baht. A stronger baht brings some genuine advantages that cannot be overlooked. 1. Cheaper imports. Businesses pay less for imported raw materials, machinery, and technology. Consumers also benefit from cheaper foreign goods like electronics, luxury brands, and cars. 2. Lower inflation. With cheaper imports, the overall cost of living can be controlled. This helps especially in times when global oil or food prices are high. 3. Higher purchasing power abroad. Thais traveling abroad or sending children overseas for education enjoy more value for their money. Thai companies can also expand internationally more easily, buying foreign assets at lower relative costs. 4. Debt relief. If Thailand has external debt denominated in US dollars or other foreign currencies, a stronger baht reduces the repayment burden. This frees up resources for domestic investment. 5. Investor confidence. A strong baht can be a signal of macroeconomic stability. For foreign investors, it suggests reduced currency risk, making Thailand attractive for capital inflows. In short, a strong baht helps consumers, importers, and investors, but that's only one side of the story. Why a strong baht hurts Thailand's economy. Thailand's economic DNA is built on exports and tourism, two pillars highly sensitive to currency value. When the baht gets too strong, both of these sectors suffer. 1. Exports become more expensive. Thailand exports rice, seafood, textiles, automobiles, and electronics to the world. A stronger baht makes these goods more expensive in dollar terms, reducing their competitiveness abroad. Meanwhile, countries like Vietnam, Indonesia, and Cambodia with weaker currencies can sell similar goods at lower prices, stealing market share. For an economy where exports account for nearly 60% of GDP, this is a critical blow. 2. Tourism feels the pinch. Tourism is another cornerstone of Thailand's economy, contributing around 20% of GDP in pre-pandemic years. A strong baht makes Thailand more expensive for foreign visitors. Budget travelers and backpackers cut down on spending, shorten their stays, or shift to cheaper alternatives like Cambodia, Laos, or the Philippines. Middle class tourists spend less on hotels, dining, and shopping. Luxury tourists may not care as much, but they represent a smaller slice of the market. Even if the number of visitors remains high, the amount each tourist spends in Thailand measured in baht declines. This results in fewer local jobs and less income for small businesses. 3. Reduced local spending by tourists. The average tourist adjusts their budget when exchange rates shift. For instance, A European paying €100 for a hotel might find it more expensive in baht terms when the baht is strong. A Chinese tourist shopping for fashion goods in Bangkok might buy less compared to before. Tourism is not just about numbers, it's about spending power, and that's where a strong baht hurts the most. Do other countries benefit from strong currencies? Yes, but only if their economies are structured differently. Switzerland chuffs Swiss franc. The franc is one of the world's strongest currencies, often seen as a safe haven. Switzerland thrives despite this because it exports high-value, luxury goods, Rolex watches, precision machinery, pharmaceuticals that are less sensitive to price. A strong franc actually benefits Swiss consumers, keeping imports cheap and inflation near zero. United States USD US dollar. The US dollar is the world's reserve currency. A strong dollar benefits Americans with cheaper imports and lower inflation. Exporters sometimes complain, but the US economy is less export-dependent than Thailand's. Oil-rich Gulf states weigh dirham, Saudi riyal. Their currencies are pegged to the US dollar because they earn in dollars from oil exports. Currency strength does not harm them significantly. A stable, strong currency reassures investors and tourists alike. Japan JPY yen. During strong phases, Japan benefits when the yen is strong because it imports most of its energy and raw materials. Japanese firms also use a strong yen to buy foreign assets cheaply. Thailand's case, why different? Thailand is closer in structure to Vietnam, China, and other export-driven economies. For these countries, a weaker currency makes their goods cheaper globally, supporting export growth. Tourism stays more attractive when foreign currencies stretch further in the local market. In Thailand's case, strong baht equals weak competitiveness in its two biggest industries, exports and tourism. Weak baht equals inflation risk, but also stronger growth through exports and tourism. This is why Thailand's policymakers, particularly the Bank of Thailand, often try to manage the baht's volatility rather than allowing it to appreciate too much. Conclusion: balance is key. So, does a strong baht equal a weak economy for Thailand? Not always, but it often brings serious challenges. While consumers enjoy cheaper imports and the government benefits from reduced debt costs, the bigger picture is that Thailand's exports and tourism, its lifeblood industries, lose competitiveness when the baht is too strong. For Thailand, the solution is not to chase a permanently strong baht, but to find balance. Too weak and inflation and import costs skyrocket. Too strong and exports and tourism collapse. The real strength of Thailand's economy lies not in the value of its currency alone, but in how effectively it manages this delicate balance to sustain growth, competitiveness, and stability.